Hello and welcome to the webinar titled Insurance Funding and Alternatives in Buy-Sell Planning. I'm Shannon Griffin of the Society of Financial Service Professionals, and I'll be your moderator today. Today's FSP Go webinar is the second of two programs resulting from attendee feedback from a recent program with Jim Aussem entitled Methods to Fund Buy-Sell Agreements. Along with very favorable reviews, we also received many requests for Jim to take a deeper dive into some of the topics he touched on in that original program. On June 10th, we offered a program in which Jim addressed alternative clauses and sample language in buy-sell planning. That webinar recording is available for purchase on fspgo.com if you are interested in that content. And today we present the second follow-up webinar in which Jim's focus will be on the use of insurance funding in buy-sell planning. Now, just a couple of quick housekeeping items before we get into the presentation. First, this webinar is being recorded and you will be able to access the recording in a day or two by logging into your FSP Go account and going to the My Account tab and then Downloads. And you can access a PDF copy of the PowerPoint slides right from within the webinar by clicking on the tab that says Handouts. And the PowerPoint can be accessed in your FSP Go account as well. And we will save time at the end of the programs for any questions you have for the presenter. Just type them in the questions feature on your control panel. And now to our presenter, Jim Aussem, JD, AEP. Jim is a shareholder in the Cleveland law firm of Cavitch Familo Durkin Co. LPA, as well as a member of its board of directors and co-chair of the business practice group. Jim's practice is focused on succession planning, mergers and acquisitions, as well as estates and trusts. He is past president of the Society of FSP and has been active in the Cleveland FSP chapter. He is a frequent speaker, facilitator, and instructor for many professional organizations. Jim, thanks for being back with us again, and I'll turn it over to you.
Shannon, thank you very much. I'm happy to do this. I was very pleased that people wanted to, quote, take a deeper dive, and this will be just that. We're going to get into more of the funding and the conditions and things you must consider when funding, as opposed to actually drafting agreements. I hope this is useful to those of you who are members of FSP or CFPs, NAPEC, or otherwise who might be doing this kind of work, because in succession planning, funding and the alternatives to funding are something that is very important, I have found. So let's first talk about the types of buy-sell agreements, and we're going to talk about redemptions. Redemption is whereby the entity is the buyer. And the entity quite often nowadays is a limited liability company, because limited liability companies can be taxed as disregarded entities if it's a single member, can be taxed as a partnership if more than one member, and if a single member could also elect to be taxed as a corporation, or if multiple members elect to be taxed as a corporation. And then underneath that, you would have a status of a S corporation or a regular, or otherwise known as a C corporation. A cross-purchase agreement is between the members, the shareholders, the owners, and they acquire insurance on each other, and they buy the units of membership interest or shares at the time of a member or shareholder's death. And the hybrid method is just that. It's a little bit of both, and sometimes it's called wait and see, and the idea there being at the time of a death of a member or shareholder, the analysis would be made as to what is the best structure vis-a-vis should a corporation buy / the entity, or should the other members / the shareholders buy. And that becomes problematic, however, when you talk about insurance funding. So let's take a deep dive into redemption planning. Sure, first of all, the insurance should be owned by the entity, and the entity is obviously the beneficiary of the life insurance as it receives those life insurance proceeds for the purpose of executing the redemption arrangement. Quite often, the insurance is not sufficient to cover the entire purchase price for lots of reasons, which we'll get into, I think. So therefore, usually we also draft the agreement in such a way as any shortfall of the entity's funding at death will be guaranteed by the other members, because the deceased shareholder or member's estate is virtually acting as a lender, okay? And therefore, I'm getting some feedback. I'm not sure what that would be. All right. I think everybody was muted, so hopefully that's not an issue. And the impact upon the balance sheet, keep in mind, if the entity is the buyer in a buy-sell arrangement and the entity receives life insurance proceeds, we want to force those proceeds out. But if, in fact, the proceeds are not sufficient to fully fund the purchase, then that balance, that promissory indebtedness of the entity hits the entity's balance sheet, which could impact the entity's ability to borrow money, operate its business, working capital, can have all kinds of considerations that sometimes people don't think about when they're putting these plans together, as the redemption and entity purchase appears to be the easiest methodology because it's only one policy, one buyer, etc. But it may not necessarily be the most effective methodology.
Hey, Jim?
Let's keep going. Yes.
Yeah, sorry to interrupt. For some reason, your control panel is showing. Could you just minimize that by clicking on the orange button with the, yeah, that'll make it, okay.
Better?
That's good.
Okay, good. Sorry.
Thank you.
All right. So when we talk about a redemption or an entity purchase, the entity has to own the insurance. Well, I think if at all possible, you should try to convince your clients to use cash accumulation vehicles or life insurance policies, because that creates a lot of flexibility because there's buildup inside the policy itself. And obviously, as you recall, that buildup is tax-free accumulation inside the policy, and that tax-free accumulation can be used for lots of purposes, including supplemental employee retirement planning or down payments or otherwise. So there's lots of different reasons that would be useful. A down payment upon a lifetime buyout. If someone doesn't die, but they want to get out of the business and is subject to a buy-sell agreement, the cash surrender value inside the policy could in fact be used to make a down payment on that buy-sell obligation of the entity. And finally, certainly, if a lifetime buyout takes place, the life insurance can continue to be maintained by the entity. And when eventually the member of the entity or the shareholder passes away, the entity will experience cost recovery because they will, in fact, get the life insurance proceeds tax-free. So certainly continuing to have a cash accumulation vehicle inside an entity creates a lot of flexibility, and I would encourage that if you're doing this kind of planning. I think something happened here. Let me just jump on this. Okay. All right. Redemption. I think a guarantee, if the proceeds are not sufficient, is absolutely necessary. Because if no other reason, you want the members, the surviving members of the entity, the shareholders, to be obligated. You want them to be committed to making sure the deceased member, shareholder, gets paid, or their estate and trust gets paid. So that's an important ingredient. Okay. So ultimately, the seller's estate is a lender, and there should be loan covenants. And those loan covenants are described in some great length in my June 10th presentation. And I would suggest that to you if you want to take a look. We're not going to cover that today. We promise that this particular presentation would be more on the insurance deep dive approach. Other factors. Bank covenants. You have to be careful here. Now, I'm getting some feedback from something, Shannon. I'm not sure what it is, but it's in my ear. If we can
yeah, I hear it
that,
too, but yeah, not sure where it's coming from.
Okay. All right. Good. All right. So certainly you have to. It sounds like somebody's not on mute to me. That's what it sounds like. If your client is an operating business, it's quite likely that they will have a line of credit they use for working capital purposes to operate their business. There may be covenants. Quite often there are covenants in that line of credit that specifically put restrictions on what the entity can do. And receipt of life insurance proceeds may be restricted by those loan covenants, and therefore they may not be available to buy out to the deceased shareholder's estate if, in fact, the company is upside down or otherwise has problems that give rise to concerns by its lender. So if there's a factor that you might think about is if the entity has significant indebtedness, a stock redemption or entity redemption arrangement may not be the best approach, because they have to stay in the entity and they can't be used for the intended purpose, that being the buyout. I suggest, I talk about redemption and other factors, that you encourage your clients to buy as much insurance as they possibly can at the time when you first make the application, particularly if it's a redemption. Because if it's a redemption, it addresses the future insurability issues. What if that member shareholder is not insurable in the future? So we want to buy as much as we possibly can. And as a practical matter, I have found that if the entity is paying for the life insurance and therefore it's not hitting the person's personal checking account or otherwise, they're more likely to buy more because it doesn't impact their lifestyle, or at least it doesn't impact their lifestyle directly. Now, please understand, life insurance, whether it be for buy-sell planning or otherwise, is not tax deductible. So it's reducing the taxable income available to the members of the entity, but the actual payment is at the entity level and doesn't filter down into their personal checking account, and therefore doesn't impact theoretically their lifestyle, and there has to be some kind of explanation to their spouse. So I have found that using the entity approach does in fact facilitate the purchase of more insurance. The second factor that's important is the entity hopefully is going to increase in value. And so the more insurance that you have in advance, the less likely you are to have underfunding upon someone's death because you have bought insurance in anticipation of growth. I am aware of the fact that insurance carriers are going to want justification for the amount of insurance being purchased. So you can't buy 3 times or 2 times even, I'm not an insurance salesperson, that the entity might require to buy the stock. There has to be some basis for the amount of insurance being purchased. But certainly insurance funding at death will assure that the deceased member shareholder's estate is taken care of, and they're not dependent, which is very important. They're not dependent on the success of the entity after their loved one's death to make sure that they get paid for what their loved one has created. Other factors. Does it remain working capital of the entity? The excess funding. For example, if in fact the buyout is for $1 million and there's $1.5 million of insurance funding because you did all the things that I talked about, you bought as much as you could possibly buy that the insurance company would allow you to buy, and that was $1.5 million, and so the corporation receives $1.5 million at the shareholder or member's death, but only is required to use $1 million. What happens to the excess? Does it remain inside the entity as working capital? Because remember, it was received income tax free. If it's distributed to the remaining shareholders from the C corporation, it's probably going to have to be booked as a dividend. And if it's distributed to the decedent's estate, in other words, if the decedent gets the excess insurance proceeds, I'm not completely positive, but I think it would be considered Section 691, income in respect of a decedent, because it would be treated as a bonus or ordinary income. Otherwise, it's not deductible by the entity as it's paid out, and therefore it becomes ordinary income to the decedent's estate. So think those things through when you're talking about what to do with the excess proceeds. Maybe the best situation is to leave it at the working capital of the entity as opposed to trying to do something else with it. Other factors which you really want to think through when you're talking about a stock redemption, and that is that there is no step up in basis to the surviving shareholders or surviving members of the entity. The entity has purchased the units of membership or stock. It does not have a step up in basis per se because it is making those shares of stock essentially treasury stock. That's what happens to it. Whereas in a cross purchase agreement, there is a step up in basis. That could be very, very important, and we'll talk about that later when we get into the cross purchase arrangements. What happens to the life insurance that's owned by an entity when the entity goes away or when the entity has complications? That may be difficult, and we'll talk about that in some greater detail here in the next slide. The C corporation quite often will take the insured ownership upon a lifetime buyout, and therefore it is an event when you transfer a life insurance policy to an insured. And if it's a C corporation, therefore it's a taxpayer who is different than the insured. Therefore, the transfer of value from the C corporation to the insured is in fact a taxable event. And if it is a taxable event, what's the valuation? Is it the interpolated terminal reserve value? Is it the life settlement value? Is it the cash surrender value, unused premium? What is the valuation? So clearly, if in fact there's going to be an unraveling of the entity's ownership of the life insurance, that unraveling is going to have probably income tax impact and may also require other things. For example, quite often the insurance will be transferred from the corporation or the entity to the insured, because one of the exceptions to the transfer for value rule is a transfer to the insured. So that's an easy one. Okay? The trouble is when you transfer insurance from an entity, which is separate ownership from the members of that entity, to the owners in their own right, you're creating a new 3-year rule. In other words, that life insurance is now in that owner's shareholder's estate for the next 3 years, and you have to take that into account as well. And sometimes I see that's overlooked. But the problem is when an entity owns the insurance and the entity is transferring that insurance, that becomes a new 3-year rule for the recipient, quote, the insured. One of the things we also encounter, because I do a lot of mergers and acquisitions, is when companies are sold, the majority of transactions are asset sales for lots of reasons, because they're step up in basis and the assets acquired, they're done as asset sales because that way they're not buying the unknown liabilities that you would otherwise get in a stock sale. And quite often, virtually all transactions I've been involved in, the buyer is not interested in the life insurance owned by the entity on the principles of the selling entity, and they treat it as an excluded asset. So therefore, now the entity has to do something with those policies, because for tax purposes, quite often we make the entity go away so that inside basis and outside basis, I won't bore you with all the details of that, can be utilized in the tax reporting of the owner's principles of the entity whose assets have been sold. Therefore, we now have disposal of insurance that was owned by the entity. Well, first thing you should do as an advisor is sit down with your client and give them an in-force ledger so they know exactly what the status of that policy is. For example, and unfortunately I've experienced this when people didn't look into it. The policy may have been borrowed against for years, and the cash surrender value now is being eaten away to keep it in place. And if the policy implodes, in other words, if your client stops paying premiums because they don't want to fool with it anymore, they've already sold their company, their need for the insurance is gone, quite often that implosion of a policy will create ordinary income to the insured or the entity, because the borrowings have exceeded, and therefore they now have a policy that they have income on, and they don't have any death benefit. That is a very bad result, and you should be aware of those facts before you make any final decisions. The question I always ask, too, of the insurance professionals is surrender of the policy the only option? Because surrender of the policy in a fact like that, where the policy is upside down, is a taxable event, and clients hate taxable events when they give something up and all of a sudden they get a 1099 from an insurance company that says, oh, by the way, you have ordinary income. Not a good result. One of the things that we can consider is, do we continue to pay the premium, maintain the death benefit as an entity asset, or transfer to the insured? Well, transfer to the insured, and then from the insured to an ILET. Well, keep in mind, when you transfer to the insured, that eliminates the transfer for value concerns, but it also is probably, depending on the status of the entity, a taxable event to the extent of the value of the insurance policy transferred to the insured. And then when the insured transfers it to an ILET, it remains in the insured's taxable estate for 3 years, plus the insured is transferring an asset which, when transferred to an ILET, creates a taxable reportable gift. So there's lots of impact of this unwinding of life insurance owned by an entity. What is the value? ITRV, for those of you who have forgotten, means interpolated terminal reserve value. And it's quite often, I believe, the value you get from the insurance company when you ask them the value of a policy that's currently in force. I think, and I've done this a couple of times, life settlement options are useful. They quite often, frankly, will pay more than the insurance company would do on a cash out or a surrender. And I'm going to suggest to you, as good advisors helping your clients, if your client's entity is going to be the selling entity and the insurance is owned by the entity, you investigate all of these insurance options before any final disposition and structure of the transaction is determined. Because once it's locked in, it's pretty hard to unravel things and go back to the buyer and say, we got to have a stock sale because it's going to cause us all kinds of other problems, or we need to continue to pay something we don't want to pay because the policy will implode. You want to have that information available to you before you make final decisions. Let's talk about cross purchase. The fundamentals, pretty straightforward. Instead of the entity owning the insurance, the shareholders, the members of the entity own it on each other. The math is pretty simple. For every shareholder, they have to own a policy on every other shareholder. So if there's 4, they own 3. So that means you have to have 12 policies. And that's where most people, get upset because they don't like multiplicity of policy, keeping track of all the policies, paying all the premiums, tracking them on a regular basis, which is why the entity is easier, but probably for lots of the reasons we talked about, not better. The premiums are paid usually by an entity, and the payment is taxed to the owner. And let's make sure we understand what that means. If I own a policy on Shannon's life, okay, I pay the premium based on Shannon's life expectancy. Shannon is significantly younger than I am, so my tax treatment of that payment is going to be minimal. Now, if Shannon owns a life insurance policy on my life, I'm an old guy. That insurance policy is going to cost 5 times more to insure me than it does to insure Shannon for the same amount of money. But Shannon's going to end up getting a 1099 or that differential added to her W-2 by the entity every year to account for the policy. The reason we suggest that the entity pay it and you just account for it for tax purposes at the entity level is that way you were assured it's paid. You're assured that multiplicity of policies is being paid by the entity. You're not relying on those 4 other shareholders / 3 other shareholders to make sure they're maintaining all of their policies. And that's a critical concern, because if the policies are not paid and the policies fail, when somebody dies, they're not there, and has the insured actually been notified that the owner has failed to pay the policy. You can make those things work, but it's part of your planning requirements as the financial advisor, the insurance professional, to make sure these things are taken into account. Member who dies owns policies on other members. Think about this. Now, if I own a policy on Shannon's life, okay, and I pass away, Shannon's going to receive insurance proceeds rising from my death, and she can buy out my estate. But my estate also contains the life insurance policy that I own on Shannon's life. If I have creditors and they have claims against my estate, that particular policy now is subject to my creditors' claims, not Shannon's creditors, but my creditors. And I'm deceased, but it is part of my taxable estate because I own that policy. So we want to make sure there's some disposition of that policy that's accounted for as part of the planning. Okay? All right. A transfer of policies from decedent, the policy is owned by decedent to another. Right? The way that works is this. If there are 3 shareholders, I own a policy on Shannon and I own a policy on Patty, and they own policies on me and each other. Okay? When the policy that I own on Shannon's life is going to be transferred to Patty, that's a transfer for value, unless there is some exception that takes it out of the transfer for value rule. The transfer for value rule under Section 101 of the Internal Revenue Code is the way to convert life insurance proceeds into taxable income, which obviously we may and we certainly want to avoid. One of the things we suggest with cross purchase, because we think there's lots of reasons it works and works well, is that you consider an escrow trust partnership arrangement to eliminate multiple policies. In other words, that entity, that escrow, that trust arrangement, that partnership, if you will, owns 4 policies. If there's 4 shareholders, it owns 4 policies, 1 in each shareholder. And because they're members of the entity, they own an undivided percentage of that policy based on their percentage of the entity. Okay, same thing. If it's a partnership, that transfer for value that would otherwise occur on the transfer of the policies upon my death, the policies that I own to the other members would be free of transfer of value, because that's one of the exceptions. In addition, if the owner of the policy has creditor issues, It may be subject to a lien or a claim if it's owned by the partnership or the entity, okay, that should remove that from that concern. And those of you who are aware of the fact, certainly in Ohio, we have exemptions for life insurance under state law so that the life insurance is exempt from creditors' claims. Those exemptions don't apply unless the owner and the insured are related, husband, wife, parent, child, etc. Business owners are not going to qualify for those exemptions. It's a different approach, but it makes sense when you think it through. Cross-purchase considerations. Well, if the policy is what we have suggested it be, and that is that it should, in fact, be a cash accumulation vehicle, then it works for purposes of voluntary departure, disability, termination of employment, a lifetime buyout. Now let's, quote, drill down and talk about those options. If the owner leaves before they die, what happens to the policy? Is the owner allowed, or excuse me, is the insured given a right to acquire the policy owned by the other members or the entity at its intermediate term reserve value? Is that an option? I think clearly it is an option, and it's something that needs to be addressed, because quite often these plans are unraveled before there is a realization of death proceeds. Should the owner who leaves be required to transfer the policy to the insured gratuitously? In other words, if I'm insuring Patty's life and I leave and the company buys me out under various and sundry ways, and I still own a policy, should I be required to transfer it to Patty gratuitously? In other words, free of charge. And if it is, then I'm making the gift, right? And are gifts related to business transaction? Need to think that through. What's the consequence of making that condition? Should the owner who leaves be required to transfer the policy to the remaining shareholders and members? I think potentially yes, but again, is there consideration for that? And is there any form of transfer of value created? So think through a lifetime departure. Now, one of the things we have used with some success, and we would recommend that you consider in your planning, is using an insurance limited liability company. Essentially, you are taking a cross-purchase arrangement and the benefits of a cross-purchase arrangement, and you are using the simplification of mechanics of redemption, as the LLC owns a policy in each member, as opposed to each member owning policies in each of the other members. When someone dies, the proceeds are then received by the LLC, and the LLC then buys the interest of the deceased member, and that deceased member's interest is allocated to the other members in proportion to their ownership of the entity. And that works quite well. The death of the owner policies ensures that the surviving remaining members avoid the transfer for value, because LLCs are taxed as partnerships for federal income tax purposes unless they elect otherwise. In this instance, you would not. You would want the partnership exclusion exception for transfer for value to apply. So the LLC would be taxed as a partnership. The nice thing about the insurance LLC, the entity, the operated entity that has the line of credit, the bank arrangements, the term loan, whatever you have in place for your client, is not a party to those lending arrangements. Therefore, the lending covenants don't apply to the cross-purchase arrangements. Therefore, the proceeds of the life insurance certainly are going to be used for the intended purpose of buying out the deceased member's estate. And the concept of charging order, which is a concept that's in most states, clearly in the state of Ohio, says that the creditors of a limited liability company or the members of a limited liability company have one remedy and one remedy only. That remedy is a charging order. And that remedy basically says the only thing that that particular creditor can do is make a claim against a distribution to the member of the LLC. And if I die, there's no distribution to me except by the purchase of my interest. And the proceeds are not going to be subject to that charging order. So we think that eliminates that concern as well. The concern being that the insured passes away and the policies they own on the other three shareholders are in their taxable estate and could be subject to the creditors of of that person, and the insurance LLC should eliminate that complication, that mechanical flaw. Hybrid wait and see. A hybrid method means just that. We're going to have to decide whether the corporation or the individuals are going to be the buyer, and quite often that's a last-minute decision based on the structure, the tax laws, and any numerous myriad of things that may impact that. And from your purpose, you've got to sit down and decide, do we want the entity to be the purchaser, or do we want the members to be the purchaser? Obviously, if it's going to be the members, and if you don't use an LLC or an escrow partnership arrangement, then you're going to have multiple insurance policies owned by the members or the shareholders and other members. If you want the entity to be the purchaser, then you're going to have a pretty simple transaction whereby the entity is going to own a policy on each one of the member shareholders. That's mechanically simpler. And the question then becomes, do we want the entity to have the mandatory obligation? My suggestion would be this. When you're doing this kind of buy-sell planning, either the shareholders or the entity, but someone should have an obligation, a legal obligation, to buy the stock or the membership units of a deceased member shareholder. Whether it be the other members or the entity, someone should be obligated to do that. It should not be an option. It should be a mandatory transaction. And obviously, the decedent's estate should also be obligated, as a mandatory obligation from a legal standpoint, to sell. And what you want to do is make sure your agreement, and the wait and see means we're not sure whether the entity or the members or the shareholder should be the purchaser, but whoever owns the insurance, whether it be the entity or the other members, is required to pay the insurance proceeds out. So they're forced out. Then any other shortfall that may come, if the insurance is $1 million and the purchase price is $2 million, and the insurance is owned by the entity would pay out the $1 million. Okay, and then the surviving members would obligate themselves to pay the balance if that's the better tax structure. This kind of wait and see hybrid is almost exclusively driven by the tax consequences at the time of the shareholder / member's death, and we can't predict those in advance, but we do want to make sure that the insurance is forced out. One-way buy-sell, I think, is a very, very useful technique. And what it usually is used is when there is a key employee or a key family member who is going to take over the business, but for lots of reasons, they're not going to do that during their lifetime. They're usually considered the designated successor for sure. They're going to run the company. And today, and I can't predict what's going to happen tomorrow, as you know, there's lots of things going on in Congress right now that could change. One, the federal state exemption of $11,700,000, and could in fact change the step up in basis at death. There could be carryover basis at death, which could change a lot of this thinking. But the concept behind the one-way buy-sell is that the person who's going to get the business should be obligated to buy the stock. If in fact the life insurance proceeds come to them tax-free, which they should, and they use those proceeds then to buy their parents or their boss's stock, then the boss or the parents can have that stock inside a trust or some vehicle whereby the proceeds of the purchase don't come back to the key employee or family member because they're getting the business perhaps at a good bargain price, but in fact then go to the other members of the family who are not involved in the business, and therefore they're getting life insurance proceeds in lieu of getting the business. And I tell people, when you give stock in a closely held business or membership units in an LLC to members of a family that are not active in the business, you are simply lighting a fuse. At some point in time, that person operating that family business is going to be obligated or want to buy back those membership units. And it's counterintuitive to think that someone who is running the business is going to run it wildly successfully so they can buy their siblings out of the business sometime in the future for a significantly inflated price because they have been so successful. It's really counterintuitive that they will not do that, and therefore this sets up a basis whereby the owner of the business can buy it from the family or the senior ownership, and yet the members of the family who are not involved will get the functional equivalent. So what happens is the key employee, family member, whoever that is, buys life insurance on the owner or the owner's lives. They're now the owners. We like to make sure the premiums are paid for all the reasons we talked about before, because we don't want the policy to lapse. We don't want there to be issues. So usually the entity will make sure that the premiums get paid and they're bonused or simply reported to the key employee family member on their W-2. And therefore they pay tax on it. But the key employee at the death of the owners receive the life insurance proceeds, which give them a step up in basis unless the law changes, and they can move on from there. Now, the nice thing is the insurance proceeds are received tax-free. The proceeds are paid to the owner or the decedent's estate in exchange for the units. The key employer family member acquires the company for a price of a premium payment, a life insurance premium payment, as opposed to a full purchase. Probably the most inexpensive way to transfer a closely held family business is through the payment of a life insurance premium. And the family members who are not involved in the business get the dollar equivalent. This is often done through life insurance as well, where the successors are obligated under the terms of the buy-sell agreement to purchase the business. And the example that I use is where the senior member goes through an analysis with perhaps your advice and your counsel that says, we have a $2 million business here, but you only need $1 million because you've already put away lots of things. So why make your son or daughter pay $2 million for something that you only need $1 million for? Well, so you work out something where they only pay $1 million. But the kids who are not in the business just lost out on additional $1 million of inheritance that they would have received had the senior generation sold that business to a third-party buyer who they have no motivation to give a discount price to for $2 million. So therefore, what we suggest quite often is that the life insurance be owned by an irrevocable life insurance trust for the difference, or $1 million, and the beneficiaries of that $1 million irrevocable life insurance trust be the members of the family who did not get the bargain purchase price on the family enterprise. Works very well. It's the same concept of the one-way buy-sell, but it makes sure that the proceeds get to where you want them to be. Cross-endorsement buy-sell. I have only read about this. I've never done one, but I know that I have a friend in Houston who wanted me to talk a little bit about split dollar. And split dollar is still around. It hasn't gone away. It's had some clarification, if nothing else, by the IRS a couple of years ago. And this cross-endorsement buy-sell, it's kind of a unique animal, at least the way I read it, where it says the owners of the business have a policy in their own life. Okay? And they don't name the other owner of the business as the beneficiary of that life insurance policy, because that would be making a taxable gift. There's lots of reasons you don't do that. And I think we covered that in the June 10th presentation. If you have some concerns about that, call me. Happy to walk you through it. So generally, the entity will bonus funds to the other member to maintain the policy, and each owner names their own beneficiary. And their beneficiary could be their spouse, their children, a trust, lots of different ways to do that. But that owner of the policy allows an endorsement on the policy, endorsement method of the split dollar. So the endorsement is in favor of the other owner of the business who, quote, rents the death benefit. Isn't that an interesting term? Because rent is different than a normal split dollar arrangement, because with rent, you're not getting anything back. It's not like you're going to get your money back. And therefore, if in fact the insured who owns the policy and has named their spouse as a beneficiary has rented enough of the death benefit to their fellow shareholder, that fellow shareholder receives the death benefit necessary to fund the buy-sell. Let's walk you through an example. The insured who owns the policy names their spouse primary beneficiary. The policy is $2 million. The obligation under the buy-sell agreement that the other shareholder is obligated to pay is $1.5 million. So when the insured dies, the other shareholder receives $1.5 million that they have, quote, rented, unquote. They pay that $1.5 million to the insured's estate. The stock transfers to the other shareholder, and the surviving spouse gets $1.5 million through the sale of the stock, where there was a step up in basis because it was in the estate, and the insured's surviving spouse gets the balance of the policy that was not cross-endorsed to the extent of $2 million. And I think if you think that through, the insured's estate beneficiary, surviving spouse in my example, got the full $2 million. The surviving shareholder got the stock for $1.5 million and, quote, at the cost of the rental payment under the buy-sell split dollar calculation. I've not done one, but I think, at least on paper, as I understand it and read it, I think it works. I think it actually works pretty well. So certainly this kind of an arrangement provides flexibility to the owner of the policy, who can have greater coverage, like in my example. He wanted $2 million of coverage, but the only thing that was needed was $1.5 million. Therefore, he could buy as much insurance as the insurance company would sell him for purposes of taking care of his family, funding his estate taxes, and doing whatever else he wants, and just enough to cover the buy-sell agreement that he had with his or her other shareholder, and, quote, was reimbursed for that because they were being rented, unquote. Very similar in terms of the economics as you would have in a cross-purchase arrangement. And it's also easier, I think, if in fact the shareholder who is insured and owns the policy decides to leave the entity. They can take the policy with them without all the considerations we have talked about before, because they own the policy. There's no taxable event, there's no taxable transfer. So it continues to allow the owner insured, if they stay in the company, to also have access to the cash surrender value. But the policy, the endorsement arrangement, has to make sure they don't borrow too much of the cash surrender value, driving down the amount of the death benefit that would otherwise be available to the other shareholder to use in the buy-sell arrangement. Certainly, it needs to address a transfer of value upon the death. Generally, a transfer for value is done through the partnership exception, and the rent paid by the other shareholder to the insured is obviously income to that person, because they are receiving dollars that they can use to pay the premium, and certainly that is income. All right, there's triggers that are in all buy-sell agreements are there on your screen. Death, disability, departure, and discord. They were covered, I think, in great depth in the June 10th presentation. And if you have not listened to that one, I would suggest that you use it, because it could be useful to you, particularly in the context of understanding some of these issues that we're talking about here. And certainly in the June 10th presentation, we talked about the fact that buy-sell agreements should provide that the survivors are protected, in the sense that when somebody gets a lifetime buyout, that seller has to agree to a non-compete. When there is a buyout and there isn't sufficient cash at closing to pay it in full, there should be a personal guarantee. The look-forward provision simply means that if the company is sold, particularly in a family transaction, within a couple of 3 years, for example, at a significant premium over what the family member sold the interest at, the assumption is that the transaction 3 years ago was a bargain because of the family relationship, and they should not be penalized, and they should participate in that transaction, perhaps at a diminished percentage. The first year at 100%, the second year 66%, and the third year perhaps 33%. And certainly the limitation on salary, benefits, etc. Again, that goes back to, if there is a promissory obligation by the entity or by the other shareholders, we want them to be motivated to pay off that promissory obligation as soon as possible, and therefore we put limitations on what they can do. Certainly, if you're the person holding that note, you want to see what's going on, so you should have access to the financial statements and have knowledge, and be cognizant of the fact that if there is an entity obligation, that note is probably going to have to be subordinated, and so therefore the seller or the seller's estate is at risk, which is why you want the personal guarantees. And if there is a sale of the entity, we want the note to be accelerated. Drag along and tag along, supermajority, dissolution, and employment, all of those things are covered in great length in the June 10th presentation, and I would urge you to take a look at that. So let's talk about a few remaining things here before we get to the questions, because I think Shannon told me she wanted me to be done at 1:50, and right now I have 1:45. Hybrid plans, the option is first to the members in proportion to their ownership. That's what I like, because they get a step up in basis. And if the insurance is owned there, that would be where I would put it, if at all possible. and obviously there might be a personal guarantee and some other things. And if you use an LLC or a trust or an escrow arrangement, it's going to look like an entity purchase, and it's going to look like the mechanics of an entity purchase, but you're still going to get the step up in basis, and you're also going to avoid the transfer for value considerations, I believe. If the default is the entity, that's fine, then perhaps the entity should own the insurance. But either way, you have to figure out where the insurance is going to be owned. I've never seen it owned half by the members and half by the entity. I don't know why it couldn't be, but that gets a little more complicated, I think. But as I said before, I think the hybrid method should require that the insurance, whether it be received by the entity or the survivors, be paid in full as a down payment on the purchase, and then the remaining purchase price can be paid from whatever entity, whether it be individuals or the entity itself, is appropriate. So these buy-sell agreements should require the insurance proceeds to be the minimum down payment. Okay? There may be a minimum down payment of 10 or 20 or 30%, or the proceeds of life insurance available on the death of the shareholder member, and force those insurance proceeds out. You don't want them to remain in the entity. You don't want them to remain in the hands of the surviving members because they may be attached by creditors. They may not be available. We want to force them out. Balance of the purchase price, clearly in installments, and that installment should bear interest. If it doesn't bear interest, the IRS imputed interest rules will impute interest to it and therefore create some ordinary income. Let's talk about the other options that we have here. And I want to talk about those in some detail in terms of disabled shareholder. Disability insurance can be paid by the entity, so you can assure that risk. If the insurance is paid for by the entity, however, when the recipient receives as a disabled shareholder or member, it's going to be income to them. To the extent that the company can pay them under a wage continuation plan, therefore the insurance doesn't have to kick in for 90 days or even 120 days or even a year. So to the extent that the entity can pay them, that's good. And to the extent that there is a written plan in the entity to continue their wages should they be disabled, then those wages are going to continue to be deductible to the entity. So keep in mind, if you're going to use that approach, make sure you have a written plan. And it doesn't have to be a complicated plan, but it has to be in writing. Okay, life insurance certainly can be used as a cash surrender value or borrowing against a cash surrender value to buy out a disabled member, or if the disabled member is going to be purchased pursuant to a down payment, maybe disability payments, maybe a wage continuation, and then installments, the entity can continue to pay for the life insurance on the disabled member's life, and upon their death, experience tax-free cost recovery of all those out-of-pocket dollars. So that's a matter of taking a look at the life expectancy, it seems to me, of the disabled member, the cost of the life insurance going forward, and the fact that if the company can afford it, they can get it all back. Certainly, if there's going to be a disability payment, a wage continuation payment, at some point in time, there has to be a discussion with you as the financial insurance advisor as to when those payments start getting credited toward the purchase of the disabled shareholder stock or membership interest. Shouldn't go on forever, and then there'd be a disabled payout. Clearly, at some point in time, you get credit. And the member must relinquish ownership. And when they relinquish ownership, perhaps to get a collateral, they would get a stock pledge back to them. Finally, as we're getting into this thing, the departing shareholder, an accumulation policy is useful because you can borrow against the cash surrender value. You can also transfer the policy to the departing shareholder. And if you do, then you're obviously abandoning the ability to use the cash surrender value, and you're abandoning the ability to use cost recovery. And keep in mind, a transfer to an insured is an exception for the transfer for value rules. So you can eliminate that. Departing shareholder, certainly installment payments must bear interest. There should be collateral, and there should be some restrictions on the management activities. Discord among shareholders, same concept. If you have a cash surrender vehicle, you can use those cash surrender economics to fund a lifetime buyout, or you can actually transfer the policy itself. Okay? My alarm is telling me I just hit the 150 mark, so let me see if there's anything else I want to.
Yeah, you can take a couple more minutes if you want to. Yeah,
Okay,
2 or 3 minutes
good.
is
All
fine.
right. Okay. Let's talk about when you're talking about discord among shareholders. One of the things that I think is really important is that you keep in mind that the policy has two accesses. One is cash surrender value, which can be borrowed, or cash surrender value, which could be accessed by surrendering of the policy, which is not necessarily recommended, or the policy itself has value and could be transferred to the departing shareholder. If it's transferred to the departing shareholder, then you have to have some mechanism, it seems to me, in your buy-sell agreement to say, how are we going to arrive at the value of the policy? The insurance company will tell you the value of the policy quite often is the interpolated terminal reserve value. My experience has been in the lease and the life settlement market, quite often those policies are worth more than the interpolated terminal reserve value. And even term policies have some value. So if the policy is going to be transferred, what impact is it going to have on the purchase price? And you have to agree on that. For these buy-sell agreements to work and be effective, you have to agree in advance on the percentage of the down payment, as I said before. Let's say it's some percentage of the down payment, but if there's insurance proceeds received, then it's 100% of the available proceeds of insurance. Interest rate, non-compete, etc. Okay. So the discord among shareholders is quite often addressed through the push-pull mechanism, which I am not going to take time to discuss right now because we really don't have time. We want to get to any questions. And my last couple of things here I want to discuss with you is funding with life insurance vis-a-vis C corporations. C corporations right now have a flat rate of 21%. It used to be substantially higher than that. That was part of the 2017 Tax Act. And there's discussions right now to raise that to at least 28%, but all of that is discussions at this point. Since life insurance, particularly life insurance, whether it be in a cross-purchase agreement, a redemption agreement, a wait and see, a hybrid method, is never going to be tax deductible to whoever pays the premium. Therefore, you're much better off to go ahead and pay the premium on a non-deductible basis at 21% than you would be at 36%. The math is quite simple. And keep in mind, the 2017 Tax Act also changed C corporations, which previously had receipt of life insurance proceeds subject to alternative minimum tax. The AMT was eliminated for life insurance proceeds on for C corporations in 2017. Funny with life insurance that if somebody is not insurable, they are simply not insurable, at a minimum, I would think that the premiums being paid on the other members who are insurable could be put into some kind of a sinking fund. Now, a sinking fund is not going to take it off the balance sheet of the entity. Therefore, it could be subject to the creditor's claims of the entity, but at least there could be some funding there so that we should at least be equivalent to what is being paid for the other insurable members of the entity or shareholders. So think about that in terms of how to arrive at that number. And the same thing could be done with the excess. You could fund some portion of that, again, being subject to the to the creditors of the entity. But if the entity is successful, that may be an illusory risk. The owner is charged with the premium cost attributable to expense. So what that means is this: if I own a policy on Shannon's life, and it's inexpensive, and the policy on my life is very expensive, well, we could reimburse Shannon from the entity a bonus every year to cover her cost of insuring my life. And that, to me, is the most practical way of doing that. You can't have me reimbursing her. You can't have me making gifts to her. That's not how it should be done. Just bonus out the additional money under a Section 61 plan or something, so they have the money to pay the insurance. And keep in mind, you have to be very careful. You're an S corporation, because if you're making an additional payment to a owner of a policy on the insured, in my case, making a payment to Shannon insuring my life because my life is so expensive to insure, we want to make sure that that's not creating a second class of stock, which could blow the S selection for us. So we ought to do that through payroll. I like entity payments to a escrow or trust arrangement other words, you could have a cross purchase arrangement where there is no special LLC, but we make sure that the proceeds are paid in escrow, so we use them for that particular purpose. You can literally do the same thing with a redemption so that the entity doesn't get a hold of them, and other than the claims of the lender's covenants, the proceeds could then be held by an independent escrow agent. I have done that. I have acted as the independent escrow agent to receive the life insurance proceeds on an entity repayment or entity purchase redemption, so that the proceeds couldn't be used by the board of directors of the company for purposes other than the buyout, which obviously would have been in violation of the terms of the agreement anyway. All right, that ends my slideshow. Shannon, if there are any questions, I'd be happy to answer them.
Okay. The first question I believe you just answered, it was about if somebody is uninsurable. So I think we're good with that. The next question is, which type of plan do you usually recommend? Redemption, cross purchase, or hybrid?
I recommend cross purchase. And I may change my mind if they go to carryover basis, but certainly it allows for the step up in basis of the surviving shareholders, and they receive the proceeds tax free. So they get a double whammy. They get the proceeds tax free. So the cost of a life insurance premium is what allowed them to buy the company. And now they have a stepped up basis in the company. So if they ever sell it, they have reduced taxes. So I think that, and as you saw through the LLC insurance and some other ways, you can almost make a cross purchase look like a redemption.
Okay, next question is, have you ever done a life settlement, and is it a good idea?
I've done a couple of them, and that's why I'm speaking from my experience, is that in all three cases that I had, there was a substantial payment in excess of the interpreted terminal reserve or surrender value, which the insurance company was willing to pay. In one particular case, the clients had a second to die policy, and they were in their early 70s in reasonably good health. And one of their members of their senior family had lived substantially into their late 80s. And frankly, their kids didn't want to wait for both mom and dad to die, nor did mom and dad want to keep paying the premiums and that sort of thing. So the kids received about $700,000 on I think a policy where the death benefit was $2.5 million, and they were happy to take the money up front. As a planner and as an attorney, certainly had to explain to them, though, in writing and have them acknowledge that if once they sold it for $700,000, if their parents had died the next day, they would have gotten $2.5 million tax free. So that's obviously the value of money, the value of premium payments, and that sort of thing. But I think they work, yes.
Okay. And at the moment, I'm seeing one more question, which is, do you typically recommend that clients obtain disability insurance to fund a buy-sell?
Yes, to the extent that they can, yes, because it just gives you, and again, if you use the wage continuation plan and you leave a significant waiting period before the insurance kicks in, it can be very manageable cost-wise. And then once it kicks in, then you can apply it to the purchase price or not, as the case may be. But it certainly gives you a funding mechanism. And if you have multiple shareholders, and they're the statistics in terms of somebody becoming disabled versus dying before reaching, quote, normal retirement ages are significant, that someone will become disabled. Therefore, if you can fund it, you should fund it.
Great. And that looks like it was the last question. Not seeing any questions in the queue, so we can conclude at this point.
Thank you, Shannon.
Yeah, thank you. Just quickly for our attendees, when you log out of the webinar, an evaluation will pop up on your screen. If you take a moment to complete that, we appreciate your feedback. And a reminder that the recording of the webinar will be available in a day or two in your FSP Go account. So if there's anything you want to review again, you can do that. And on behalf of the Society of Financial Service Professionals and FSP Go, special thanks to you, Jim, for all three of your presentations on buy-sell planning. And thank you all for your registration and participation. And with that, the conference is adjourned.
Very good. Thank you.
Thanks. Thank you.